Welcome back. You're watching Stock Watch with me, Zinati Kuma, and join me to unpack your stock-related questions tonight are Alex Duys from Umthombo Wealth and Zwelakhe Mnguni from Benguela Global Fund Managers. Be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Thank you so much for your time, gentlemen. Now, in about less than an hour, we will be getting the State of the Nation address. Starting off with you, Zwelakhe, are the markets, investors at all paying attention to Sona at this point, or will the news just be digested tomorrow?
Probably the news will be digested tomorrow, Nati. I think our market is hardly being driven by local issues. I mean, we've got a lot of commodity exposure. We've got the rand, we've got oil, and I think those are the big things that drive our market on most days. So I think the SONA will be more a guideline in terms of what's coming for policies or policy improvements, but I don't think it's a major issue at the moment.
Yeah, all right. Well, some of the macro news that came out today was the continuing deflationary pressure in China, of course, seeming that the economy is still facing some risks. Alex, I'm wondering if this has maybe changed your investment thesis for China or not. What was it in the first place?
Well, it's not necessarily changed my investment thesis, but perhaps it's thrown more petrol on the fire of concerns I have about China. Right. So one of my big fears of China is that they're all going to enter some form of inflationary environment for an extended period of time, and that'll be disastrous. So what's the reasons for China struggling? Obviously, they've got a huge amount of debt, and they've got also lots of asset class prices which are under pressure, specifically the property market, and that is causing deflation. Right. So how do you turn that around? It's not going to be easy. I mean, if they simply continue to build more properties or more investments in that regard, not really going to move inflation. At the same time, the consumer is just so scared and so conservative after COVID in China. So it's a very difficult period. China will have to do something to restart the economy. And I guess one of the key risks for South African investors is because we are so reliant on China is if China cannot kickstart or continues to underperform, what impact will that have on South Africa? So I'm not saying it's going to happen, but something obviously have to be cognizant of as an emerging market.
And actually something that's interesting because SoftBank had its results out today and what they've been doing, and they did have a gain on their Vision Fund. And what I noticed also there is they're kind of moving away from China stocks, from China tech, even with Alibaba, where now they're focusing more on the AI trend. Of course, there's also the investment in ARM. And I'm wondering at this point, Zwelakhe, if that would be a good move to move away from Chinese-focused tech more to US, UK tech on that front that is being led by this AI boom, or are the valuations in China just too attractive for one to just let them go?
Yeah, look, I think the timing of it may be a bit risky. That's what might bring risk to the valuations or what you pay. But I think in terms of the structural opportunities, you're looking at the US, I mean, it's probably a lot better, well-regulated, but it's the regulatory, on the regulatory front, we're not seeing abrupt changes in the regulations that govern the industries, like the internet, for example, in December had a surprise. So I think China remains a major opportunity. It's all dependent on how that opportunity is being managed by the governing party and how it's basically the political interest versus the people's interest it's a battle between the two. And if sitting today, I'd probably be skewed towards the US than China. But the opportunities are there. The valuations are ridiculous for some of the companies, including Alibaba, with their poor performance. But the opportunities are huge there.
Yeah, I actually just want to ask you, Alex, on Alibaba, because as I mentioned, SoftBank slowly moving away from it, and yesterday seeming to disappoint investors. Of course, they're also going through this corporate restructuring. But I mean, analysts have just been saying it's very, very cheap. So why not? What would you be doing at this point with Alibaba?
First of all, with China, even though I do have my reservations about China to an extent, when everyone is so negative, the contrarian in me comes down and say, perhaps there's opportunity. You need to have a closer look at China. So the valuations are incredibly cheap, especially relative to US tech stocks. So, can it get cheaper? Of course, but surely the probability of making money is starting to get better buying Chinese assets, assuming the worst case scenario doesn't happen. Now, that's always the case with China because, I mean, Zwelakhe referred to it saying that it's the interest of the government compared to the people. Well, unfortunately, you've got a communist party which always thinks about themselves as to the people. So that's likely not going to be in the favor of people going forward. So I mean, that remains a concern. Alibaba, obviously, I'm no expert looking at Alibaba, but if you look at the results, they're going to do massive amount of share buybacks. If you look at the free cash flow business expected to generate, it seems very, very attractive. So the run valuation, Alibaba, doesn't matter how you slice it, looks incredibly cheap. But I haven't looked at accounts myself. I'm not sure if the numbers are earnings quality is good and so forth. But but you can probably say that for a lot of the Chinese assets in a moment. The question is who's going to buy it? You need the Western capital to buy it to really reflect those fuller war values. In a moment, Americans aren't touching China. They're flocking actually to Japan.
All right. Yeah, quite interesting, actually. Let's move on to REITs. I am nearing retirement and considering an investment in a number of REITs to supplement my post-retirement income. Can the panel help me with a recommendation of the 3 to 5 best REITs currently? Zwelakhe, do you have that wide a variety between a 3 to 5? Would you even be going into REITs at this point?
The view caught me off guard, but I'm just thinking quickly. I think the retail biased REITs would probably be a better play at this stage, at this point in time. I think also you want to see that those REITs are not overly indebted. So if I just look at it high level, I'd probably say I'd take Dipula, Vukile, and maybe Resilient as my top 3 in that space. I mean, the yields are at different levels to reflect the kind of risk that they operate in, the kind of environment they operate in. But I would be more inclined to take those because the retail market is still growing decently in some of those markets, particularly the township market, which the top 2 will give to you.
Yeah, it's actually quite interesting because a lot of people have been choosing Dipula and Vukile as their stock picks, of course, looking at the market that they serve, the township, the rural areas. Alex, I remember you and I spoke about REITs, I think it was last week or 2 weeks ago, and you mentioned Fortress, the A-shares, I think also Nepi, Rockcastle, but you were leaning more towards Fortress. At this point, which ones would you be going for between 3 and 5?
I certainly concur as well on Dipula and Vukile. I think those are very exciting options in the African market space. I think if you want to perhaps have a bit lower risk approach, growth point, for me looks actually very attractive from a valuation perspective. The rump is still quite cheap, meaning if you strip out the offshore ventures from this African business, it's looking quite attractive. I think if you want to have some rand hedge exposure, perhaps buying directly in Nepi Rockcastle is not bad. It's yielding quite high and growing in euro terms. So I think that's something to be cognizant of. So certainly those 2, and perhaps if you look at other options that we like, business like Attack, yield is not particularly high, but it does offer you some capital upside potential. But perhaps easy money has been made there to an extent. And if you just want to take capital risk and perhaps get dividends in the future, something like Mass Real Estate looks for us very interesting at the moment. Not going to pay dividend for the next 18, 24 months, but we think it's incredibly cheap. And then when dividends do come back, we think it's going to be a very good yield and very growing also in euro terms. So perhaps you can get a blend of those 5 into each portfolio if he's looking to hold on for medium to long term.
All right. Well, let's get into banking. I'm actually supposed to be asking you guys for your stock picks today, but the viewer has given us their stock pick. So my stock pick for today is First Rand. Any views on the panel? Bought 1,500 shares at 64 Rand 22. Zwelakhe, First Rand at this point, was that a good price, 64.22?
It depends on your horizon. If you're thinking long term, I'd probably say you'd probably do okay. I think if you think in short term, in less than 2 years, I think it probably I'd say it's probably close to fair value at the current levels. The one thing is that it's a well-run bank with quite a few franchises that participate in key elements of the lending market, and I think that where we are in the cycle, I mean, we probably headed to a interest rate reduction. So you have to consider the benefit of lower impairments against the compressed base for interest rate charges that they charge to their clients. So you could get a bit of a squeeze there. But I think long term, it's a good business. It's a well-run business, good dividend yields, lower than many others in the banking sector, but it's a very well-run business.
Yeah, I know that the banking sector across the board is seen as quite cheap, Alex, but First Rand, I mean, is one of the stronger ones. And I'm wondering if you would be choosing First Rand for its strength, or maybe going for a more undervalued peer that probably has more upside than First Rand.
Yeah, so I have to concur with what Zwelakhe said. It's about the time horizon. So if you simply want to buy and hold a bank from medium to long term, then probably First Rand is the better option to do, because it's the highest quality business. In the shorter term, I actually think Absa Nedbank, for me personally, looks more interesting than First Rand. So it depends on your horizons. If you want to hold for 2 or so years, I would rather say buy Absa. But if it's going to be a buy and hold, buying at 64 odd Rand for First Rand is not a bad price in my view. But all the banks, I think, are good businesses in Africa. We'll be pretty much bullish on the banks. You know, Capitec for us, we like it, but the valuation is a bit high. But other 4 banks, including Investec, price looks reasonable value in our view.
All right, gents, more questions. The S&P 500, is it a good investment? Alex?
Yeah, it's a difficult one to answer. For me, if you look at the last 15 years, the US market has outperformed all other developed markets and emerging markets, for that matter, by a country mile. At the moment, it's all driven by the AI stocks, I mean, the so-called Magnificent Seven. And if you look at some of the results, it's been mostly good as well. You know, so it's difficult to say that it's going to stop. Also read some interesting research today that if you look at the Magnificent Seven valuations compared to dot-com crisis, they're pretty much trading at half PEs and double the free cash flow. So pretty much suggesting that, you know, upside could be even a lot more if rational exuberance comes back to the market in there. So it's a difficult bet. So if you do believe in that, then S&P 500, obviously, or MSCI World, where the US is a big component, will do well. But I'll probably think some prudent approach. You know, if you want to buy US, sure, do so, but perhaps buy one or two other markets as well, but which are a bit more buffer when it comes to valuation perspective. Ideally, we'd like to have more active managers, but if you're only going to buy ETFs, perhaps do that combination of buy a cheap market with the S&P 500.
Yeah. Alex, interesting point also that you bring up, that it's been fueled by the AI boom, but also compared to the dot-com crash, that the upside could be more. I actually asked a question in a show earlier on, if maybe, because obviously the S&P 500 has run pretty hard, if maybe this would not be an opportune time to take profits there and come back home, Zwelakhe.
Yeah, look, I mean, if you say come back home to South Africa compared to the S&P 500, I'd probably stay in the US if that was the choice I had. But if you say to me the S&P 500 was one of the options that I had, I'd probably have to think hard. I mean, in terms of putting money there, I think the bulk of the performance in the S&P has been through the Magnificent Seven. And that has certainly left other elements of the market being relatively attractive.
Yeah.
So you basically probably getting a mixed bag where the value of the the top market cap stocks is inflated. I believe that there is a risk of a correction. I think this whole AI thing, we were having a discussion internally about everybody's talking about data centers buying these AI chips. But to what extent are the data centers themselves using that capacity? Because you basically almost doubling your processing capacity on the same infrastructure. And is there demand immediately that can come through and take up that space? Because if there isn't, at some point we're going to see a rollover of the demand for the chips, and there's going to be like a lull. So I think there is a risk in that space. So I would want something that can give me a blend, but currently probably the 40% of that S&P is probably the large cap stocks, the top 10 large cap stocks. So I would probably be a bit more cautious about the S&P, and I'll try and find value elsewhere.
A sobering perspective there. Let's go into commodities. Anglo-American. Why is Anglo-American falling so much? Surely at 415, it must be a buy, or am I missing something? Are all commodities at this point not a buy because of how badly beaten they have been? Alex, actually, let's start off with Anglo-American.
Look, I mean, first of all, commodities can always fall a lot more than you think you can. So be careful to try to catch a falling knife.
Yeah.
Anglo-American has been weak. I mean, look at the components of Anglo-American, right? So diamonds with the BS is one of those. They've got the PGMs with Amplats. They've got iron ore with Kumba. And of course, they've got their own copper assets and so forth. Now, iron ore has been relatively stable. We saw also the results today from Kumba was solid. Platinum has been falling from a cliff over the last 18 months. So that's a key driver. Diamonds are struggling. And overall, the rump of Anglo-American. So if you strip out the listed assets, you look at what the rest is valued at, it's actually the cheapest it's been in a long, long time. So it shows you the negativity within Anglo-American. One thing I forgot to mention is that last month they gave an update on the copper production, and that was very weak, and that led to a sell-off. But those predominantly are the main drivers for the reasons Anglo-American has struggled. So sentiment is quite bad at the moment. I'm seeing a lot of specifically south side, perhaps even some portfolio managers starting to talk a little bit about Anglo-American. So I'm coming with lukewarm towards the business, but I am cautious that there could be more downside for the commodity basket in general, not only to Anglo-American.
Yeah. Zwelakhe, do you catch this falling knife or just let it fall and catch it when you catch it?
Look, I'd probably say, I mean, at current levels, I'd be interested. I think what we are seeing is a readjustment both on the price side, but I think what Anglo-American has done is they've been pushing volumes down, production volumes down, to basically, because I think they talk about it as value over volume. So they're trying to make sure that they get more value for their production than just chasing volume. And I think if you look over the next 3 years, I mean, they've guided for a decline in production, I think, for the first 2 years, 24, 25, decline in production, and then 26, a bit of an improvement. That profile says to me they are waiting for a recovery in commodity prices. So they've got the capacity, but they're waiting for a recovery. I think it's a disciplined approach, but it may hurt in the short term. So I looked at Kumba, for example. They actually removed a lot more burden than last year, but out of that environment, they actually produced a lot less iron ore. Actually, that burden that they removed is an investment which they can use later. Their cost production be lower, cash cost production be lower when they actually produce. So I'll probably be interested at this level in Anglos. I think we don't know when the commodities are going to turn. I think PGMs are looking very bad. I mean, palladium is almost at the same level as platinum, and the two were if you go 18 months ago, well, probably palladium was sitting at 3,000 and platinum was sitting at just over 1,200. So there may be opportunities. I think it's going to be a very difficult 12 to 18 months looking at. But if you think in long term, this might be a good point to enter the cycle.
All right. Let's go into education. Advotech consistently proved itself over time, and its African growth strategy works. I feel they are overvalued. Not sure if I should cash out or hold on. Yeah, let's actually start with that. Alex?
Look, we like Advotech over medium to long term. So we think this is one of the few stocks that we can probably buy and hold and put it in your bottom drawer. Got good growth prospects.
Yeah.
So I think the expansion to Africa seems quite good. They're doing it in a measured approach and actually quite profitable. And quite a nice growth as well in South Africa. There's now, of course, change in management, so we'll have to see if there's any change in strategy. But business is extremely cash generative, and they've been investing quite well. So yeah, I think this is certainly, in our view, a buy and hold business. Does it mean it can perhaps overrun from a valuation perspective in the short term? Yeah, sure. I think it has run very strong. But if you're willing to hold this for longer term, I think it will grow into valuation and it'll make a lot more money, in my opinion, over time.
Yeah. Well, the second part of the viewer's question, what is the view on Stadio currently? Is it a buy, Zwelakhe, as we're sticking with private education?
Yeah, I don't follow Stadio very closely, but I think they have seen a shift away from bricks and mortar business into online.
Yeah.
I don't know what the dynamics are, the implications are.
Right. Alex, any thoughts on Stadio?
Yeah, we like it a lot. So they're obviously targeting distance learning. So think of competition for UNISA. And anyone that's followed the media over the last year or so would know what shambles the UNISA is. So I think there's a big opportunity for Stadio. They can get some of those students through, specifically if they can get NSFAS funding and so forth, into Stadio. So I think there's another one that's put in a bottom drawer. The cash flow profile is a lot different in Stadio because it doesn't need to put a lot of capex in, doesn't need to build big schools and so forth. So quite a nice J curve in this. I think the business is going to be cash flows quite soon, and as a result, you can expect big dividends as well sooner than later.
All right. Just quickly, gents, Invicta. I've been holding Invicta for some time now. Seems not much is happening on the share price. Should I cash out or keep holding, Zwelakhe?
I haven't followed Invicta in a long time, but I just think that the ownership structure doesn't give me comfort. I think the business model is not comfortable to me in terms of the imports of equipment and the like. So it's not a business that I follow particularly because I'm not comfortable with the ownership and governance structure.
Yeah, not one that a lot of people talk about. Alex, Invicta, any thoughts?
Yeah, we like it. Also like a Dake as well, quite similar. But if you think about Invicta, valuation is very compelling. Liquidity is quite poor, so as a result, it's difficult for institutional investors to get a big chunk in there. And that's, I guess, one of the main reasons for the share price perhaps being far below fair value. I concur there's some issues on the government, and that's always been the biggest weak point there. But I think Stephen Joffrey has done an incredible job since he's come in. I like his leadership. I think he's taking business in the right direction. And there's so much good cash, and they'll continue to buy good dividends or acquisition and share buybacks. I think that's a good recipe, and a big rand hedge as well. I think that's important to note. A big chunk of their revenue actually coming offshore, so it's a nice way to buy a rand hedge in South Africa if you don't want to buy one of the traditional big 40 stocks. All
right. Well, let's get to your stock picks for today, gents. Zwelakhe, what are you picking for today?
I'm going with Italtar. So they have a vertically integrated tile manufacturing and tile glue manufacturing. I think it's probably fallen quite a bit. It's probably down 60%. And my belief is that, it's been a business that's proven to be resilient. It's if you look at what is called the home improvement retail in South Africa, in the last 10 years, that segment of the economy has grown at about 10% per annum. And if you go 20 years, it's grown even at around 15%. It's an area of resilience. It's where people are trying to invest in their own homes. And this business has fallen quite a lot because of their last result, particularly. I do think that it's an opportunity where it is at the current level.
All right. Alex, what will be your pick for today?
Yeah, so I'm going for another South African small cap business. This is Argent, but predominantly a business of manufacturing, commodity trading interest in SA, UK, and a little bit of the United States as well. Similar to Invicta, it's got quite a nice offshore component. So if you look at the last interim results, 75% of the profits actually came from those offshore ventures. So it makes it quite a good rand hedge. Also, the fuels business, which is predominantly in the UK, has got a very healthy order book, and it's got very, very high barriers to entry. So we like that business. We think there's a lot of potential there. But why I also like it specifically is the valuation. Business trading at a P of less than 4, less than half a book value. Got dividend yield of more than 6%. However, it only pays out less than a quarter of its earnings, so that huge upside there. Free cash flow yield region of 25%, strong balance sheet, high net cash component of market cap region of 25%. And they're doing share buybacks. They bought about 20% of the shares back there last year. We also saw an update from, I think this week, where they sold one of their properties and as a result bought back more shares. So this is a classic example of a business that is completely forgotten by the market, and it's ridiculously cheap. Happens to be listed in South Africa, even though most of its ventures offshore. I think there's also going to be more value unlocked as they sell more assets, so forth. So we really like it. We think it's an excellent opportunity, and investors should be looking to pile in.
All right. Well, thank you so much for your time and for your analysis and your analysis today, Jens. Really appreciate it. That's all for Stockwatch tonight. Thanks to our guests, Alex Duys from Umthombo Wealth and Zwelakhe Mnguni from Benguela Global Fund Managers. Up next, The Close. Stay watching.